What did you make of this week? It was such a dramatic turnaround on Thursday. Should we believe it?
I would not. I would take it with a grain of salt. What a week it was, the midterm elections and the inflation report. And let's not forget Veterans Day. Without our vets, a big thanks to them, there wouldn't be peace. The inflation report stole the limelight, though, for the week. And arguably, I don't think it should have. It's just one data point. And while it's very welcome that inflation's come down from the highs, it still seems broad-based. And particularly broad-based in services, which suggests the labor market is still extremely tight. I'd argue that we see narrow disinflation at goods, apparel, used cars, and still broad-based service inflation. So I think inflation is still a risk. And I just remind people that in October 2021, inflation was about 6% back then. And so it's still about over 6% on a core basis now. That's a lot of inflation over the past 2 years.
Laura, that's a really good point. I mean, we like to focus on how much it's come down. It has come down some finally, but it's still at a very high level. And do we have any assurance it's going to keep coming down at a fairly brisk level to get us down to 2% or thereabout?
Well, look, I think it's all about where the numbers come in versus expectations. And if you look at street consensus, they're already baking in pretty significant moderation, kind of heading back to 3% next year. So I think it was, not surprising to me to see such a fierce reaction in markets. Maybe not, I didn't expect quite as much as what we got. But I can tell you, David, I've talked to a lot of investors the last few weeks who have really, kind of quietly arguing it was getting ready to come down, building their models, and, had gotten fooled by this, several times in the past when it didn't happen. And I think there was just tremendous relief that this kind of idea that inflation is moderating, that we finally got the data to cooperate.
It's moderating for one data point, Lori,
yeah.
But we've had the chair of the Fed say again and again and again, I need more than one data point.
Yeah.
I need quite a few data points before I'm really going to believe it. So do we think this is actually going to change Fed behavior at this point?
Well, unfortunately, I think that the Fed probably didn't like the reaction that we saw on Thursday, and I wouldn't be surprised to see the rhetoric, take another, kind of hawkish tone to try to clamp down enthusiasm. I think things are going to stay choppy for quite some time. Let's enjoy the day while it lasts. It was a nice week. We've been in need of a nice week in the equity market, but I wouldn't, necessarily expect this to go up in a straight line from here.
David, I wonder, are the markets basically baking in, really getting back down, if not to 2%, to sort of 2.5%, 3%? Are they a little complacent, particularly bond markets?
I think the markets are complacent. It's interesting how the bond market also yields fell upon the inflation report, and maybe that's all that equities need to know. But yes, investors expect inflation to come down, but at this stage we can't keep saying eventually. It's important that the Fed or other factors get inflation down quickly, because we're looking on the verge of inflation becoming a multi-year problem. And if high inflation is a multi-year problem, that might change the entire inflation risk premium demanded by the bond market. So I think we're very lucky that the bond market is staying calm about inflation so far, and we shouldn't press our luck.
So clearly the CPI drove the markets this week. They drowned out any news about the midterms. Was that right, David? Did we pay enough attention, do you think, the markets to the midterms?
Well, Lori and I were talking. It seemed like investors were trying to follow some game plan they had in mind about how the market would rally post-midterm elections. A Republican red wave didn't happen. Hopefully the inflation report wasn't a surprise negatively. It was positively. But I think this has gone too far too fast. And I think they did put too much emphasis on the inflation report, trying to ignore the midterm elections, which are still uncertain.
Still uncertain, but it looks pretty divided. It's not clear that Congress is going to do an awful lot. Is that good news for investors, bad news?
I think it's good news from the perspective of historically a divided government. When you have a Democratic president and a split Republican Congress, you're getting 13 to 14% average type returns in the S&P 500. So the history is very favorable. I think a lot of investors know that history, and so if nothing else, it gives you a little bit of confidence. I think the other issue is, in terms of gridlock being good, I think the last thing investors want right now is more stimulative policy. So I think there is good news in that. And look, I think this was a win for the markets. This was a win for democracy this week. We don't know the results yet, but things did go pretty smoothly.
Lori's right about the historical data, and we've talked about that, but I think investors are putting just too much weight on that historical observation, and I'm not sure a divided government is all that wonderful right this moment. There's likely to be fiscal fights ahead. Let's see what happens during the lame duck session. Even if Democrats hold on to the Senate, they might want to use the lame duck session to push through some more policies. And I just think the poor showing amongst the Republican Party at a time of such high inflation is not good for the supply side. And the weakness on the supply side is part of the structural problems we're seeing with inflation.
Laurie, everybody right now wants to draw parallels in history. It depends on which history you pick, but I know you've done work specifically about 2002, I believe.
Yeah, it's eerie, David. I mean, we've actually seen there's about a 78% correlation between how the S&P 500 is trading this year and how it traded back in 2002. And there are some similarities. That was another midterm year. There was a geopolitical angst in the backdrop from 9/11 and the sort of build-up into the Iraq War, similar to what we've got in Russia-Ukraine these days. And it was also a period of messy normalization after we'd had a big crisis, big drop in the market, initial rebound, and it took basically a year and a half for the market to get back on its feet, find a bottom, and I think we're doing something similar right now.
Not only 2002, 2018 was a year where after the midterm election, Fed policy and Powell taking a pretty hawkish stance at the December meeting of 2018, saying several more hikes are likely. Market fell almost 20% in December 2018. That was a midterm election year.
What about geopolitics? Laurie mentioned that briefly. I mean, we still have a war going on in Ukraine. We've got President Xi meeting with President Biden next week. Unclear what's going to happen there in Asia. There are geopolitical issues here. How much is the market discounting those?
The market is aware of it, trying to ignore it. There are certain industries where the tension's growing, like in semiconductors. But it does seem like, and even with this election, that tough on China and support of Ukraine too, I think that's the policies and sentiment that will continue to prevail.
I want to come back to something David talked about, which is President Biden said democracy is on the ballot. Former President Obama said that as well. It looks like whatever happens here, most Americans they sort of believe in the election process. They showed up, they voted. Not a lot of disputes yet, really, about what happened. How good is that for the markets? Because to some extent, the markets depend upon, a regularity of our processes.
I think stability is good. I think, the fact that the democratic process worked pretty cleanly, there weren't a lot of fights. It was kind of a boring midterm at the end of the day, other than having, polling data kind of make a lot of people disappointed in the end. And I think that's good ultimately for the investability of the U.S. when you're thinking about global investors and the premium they're going to give U.S. assets, particularly in the equity market. You need that political stability.
How big a wild card is the debt ceiling, David?
They'll lift it.
You're confident of that?
They always have. But sometimes they put us through some headaches before it's done. But it is important to acknowledge that with these interest rates, these climbing real interest rates, a little bit of a reprieve on this week, Thursday, Friday, but there's risk, especially if that inflation risk premium goes higher, that the debt and deficits will be more burdensome. Look what's already happened. Housing's getting crowded out. People are getting a lot more demanding on the valuations for innovative businesses and stocks. We're crowding out innovation. We're certainly crowding out housing.
I wonder, Laurie, a lot of talk about a possible recession next year at some point. Not clear how long, how deep, even whether it happens, but a lot of people think it's quite possible. Do we have the optionality from a fiscal point of view to deal with a recession right now, given what's going on with interest rates, given how much we've borrowed, and given deadlock up in Congress?
I don't know that we have a lot that we can do at this point in time. I think that, I think that's one of the reasons why investors are so focused on the equity side at getting the Fed to pull back while there is still time to push us into something deeper. And I think that's one of the big takeaways from this week is that even if you sort of believe the last round of hawkish Fed rhetoric, did that CPI print, at least for now, put us on a path where we can look for the Fed to take their foot off the pedal sometime early next year and avoid having this be a late 2023 recession, more of just kind of an early economic hit. I think for me, that was one of the biggest takeaways on the CPI.